Having the right TMS is vital in supporting freight broker growth. Partner with TIE Software to optimize your processes and compete with confidence. Get into the automation, data insights, and cash flow optimization game. Request a demo at tiesoftware.com. Welcome back to another edition of Check Call. Today we are covering the kind of a rate forecast into the future and a little bit of the October market update. But don't forget to subscribe to Check Call, the newsletter on FreightWaves.com if you haven't already. Today we are welcoming back our absolute favorite guest, David Spencer, the Vice President of Market Intelligence at Arrive Logistics. Welcome back, David.
Thank you, Mary. Very much appreciate being here.
I'm pretty excited for today because this is what I like to have the fun times of. And it's kind of David's, I feel like I probably shouldn't call it David Spencer's glimpse into the future because I know that there's a lot of people that work on it, but we're kind of, Arrive's calling their shot. You're saying this is what's probably going to happen in the future. And as a result, we kind of get to sit here and talk about it and see if you're going to be right, if you're going to be wrong. Let's get into it. So what are some of these big trends that we can kind of expect to see for the rest of 2023 and 2024?
Yeah, well, first and foremost, let me kind of preclude this with yes, we have a crystal ball and we know exactly what's going to happen. So, no, obviously, look, we're putting out there our thoughts on what we think is the most likely scenario based on the information we have right now. Right, that's how we're making decisions and how we're thinking about how to proceed and strategize as a business. And us putting that out there is really meant to help, facilitate conversations and, open the door to these conversations with those that we work with, both shippers and carriers, about, how we navigate these times together. So, happy to talk about what we're going to see. And then obviously, the rest of this year and into next year, we hope we get it right, but we obviously know that that's really hard to do on a consistent basis. But for this year and into next year, what are we seeing? Well, I think, from a rate perspective, we believe we're sort of at the bottoming from a spot market perspective. We're at the bottoming of the freight cycle here, right? So what does that mean? We think both van and refrigerated rates are at a floor. And we're still seeing a large delta between where spot rates are at and contract rates. And so from that perspective, we think that there's a little bit of a ways to go before the market is truly vulnerable to disruption and before we see, a market flip. The rest of this year, we're on board with the muted peak season conversation, but we think it's a slightly dangerous narrative because we think that shippers should be aware that, even though it's a more muted peak season and less volatility out there, there's still going to be volatility in the areas that typically see it, and that's what we're cautioning.
I kind of like that you guys have called it a muted peak season because I know that some of the internet has caught on to weak season. And I mean, look, weak season, peak season, it rhymes, it's catchy, it makes sense. But at the same time, weak season makes it sound like there's going to be 3 trucks on the road and, there's not going to be much demand. But like you said, there will still be demand. It won't quite be what we were used to seeing in previous years. But I much prefer the muted peak season over weak season just because it still is there's still going to be one, but it's just going to be a little more.
Yeah, I mean, really, the initial start to the fourth quarter here supports that, right? We're in a little bit of a lull. We've seen accepted volumes on the CLAV.USA really kind of fall off into the middle part of October here. And, we're still seeing spot market demand fall off as well. And so those are trends that we'd expect to see coming into the beginning of the fourth quarter and stepping back from end of quarter push in September. That's a more normal historical pattern. It deviates from what we saw over the pandemic. So it feels like a big slowdown. We're not used to that from a recent memory perspective. But it definitely gives some support to the concept of a muted peak season. Seeing that lull, I expect a very similar fourth quarter to what we saw a year ago. So if you think back to the challenges we saw then, I would say expect similar challenges again this year.
I would say kind of, since you guys are out here calling your shot, saying this is what we think, this is what's going to happen, What made you guys like want to just share it with the world? Because you could have kept your crystal ball all to yourself and said, "This is mine. I'm going to take it," and you guys can just find your own crystal ball.
Yeah, I mean, having an idea of what's coming, to some degree, there's components of how we see this playing out that are going to affect our strategy that we certainly are going to hold close to the vest. But in terms of what we expect to see from a larger market uh, perspective or larger market trends, I mean, this is what this is how we build trust with those that we work with, right? On the shipper side in particular, we're not just throwing darts. We're not making decisions based on what we need to happen as a company, right? Like we are open to these conversations. We think a lot of benefit comes from these conversations. It builds better relationships with those that we work with. It opens the door to conversations with those that we don't currently work with. And ultimately, if we get people operating this industry off of, um, information and data, that's ultimately better than people operating off of instinct and survival instincts in some cases, right? And so, we've gotten a lot of positive feedback from this, a lot of engagement, and we continue to put this out there from that perspective. Also, we all know it comes down to execution, right? Even if you know what's coming, we're confident in our ability to navigate any market and up against any of our competition and be successful. And so we're not too scared to share this information.
Just a casual, humble brag in there of like, yeah, we have the data and we know how to use it, and like we're not worried. We're not worried because, like you said, that like all the data's out there. You guys just kind of compile it and make some analysis about it, but it's really all about how you in turn use it and apply it in your business every day. So I like it, but no matter what, Arrive's got it. So what is kind of the everyone's kind of focused on van rates, which is a little bit sad for some of the other modes of transportation, but I understand that van rates kind of are a lot more predictable and easier to kind of know what's going to happen from. So how is or what's the expected growth kind of for rates, for spot rates in the rest of the year? And then also, are we going to see some drops in rates once the new year starts?
Yeah, I think we're expecting to see rates pick up in line with seasonal expectation here on the van side of things as we get into the fourth quarter. I'll try and hold back from talking about what we'll see on refrigerated equipment, but because I think we'll probably dig into that a little bit later. But we expect van rates to pick up off the floor a little bit, like I said, in line with normal seasonality. From that perspective, that should carry into January. That's a time we tend to see drivers and carriers see a lot of time off. That creates some more disruption in the industry on a short-term basis or seasonal basis. The back half of Q1 is always slow. February, always slow. We don't expect that to be different this year, right? But one of the key trends we're interested in is what happens with contract rates through the RFP season in this fourth quarter and into the first quarter of next year. What that does to how carriers continue to be able to service freight at these rates, particularly brokers, those that might be making decisions based on trying to survive, right? Going low with rates. As rates pick up a little bit, as we see capacity exit the market, we're going to see that vulnerability to those, especially on the broker side, coming in with low contract rates, to some disruption there, right? And so we go through another round of RFP reductions here, RFPs with contract rate reductions. We think there's some definite risk for those that are trying to go low to grab market share, and that creates vulnerability when these rates go live and when we start to see rates pick up. So we're talking, early produce season, early construction season, when things really start getting going out there. Say March of next year, that's going to be our first test. But ultimately, as we get into that summer peak season next year, mid-May through July 4th is really when we expect to see some of those give backs really pick up on the contract side.
So basically January, February are going to be as sad and depressing as usual.
I would say the back half of January into February. It depends on who you are, right? If you're a shipper, it's going to be nice to get some reprieve from the holiday rate volatility. But yeah, I mean, there's a ways to go before this market is truly vulnerable, right? So look at those typical seasonal trends. Late January into February. That's typically a slow time. There's not a ton of seasonal freight moving at that time, and so shippers should see easing rate pressures, and carriers on the spot side of things in particular, we're going to see some of that opportunity dry up. But a lot of freight going live at that point in time. That's really what we're going to be paying attention to is shippers' ability to see those contracts maintained through rate volatility through the first half of next year. That's going to inform our forecast and how we update our forecast as we get into the first part of the year.
So we're going to go to the cold side of things now, the other land that I live in. I feel like reefer rates and reefer demand has been so high in the last month all of a sudden. Like I know the Pacific Northwest, as we mentioned last month, has their harvest season, but what's kind of the expectation for them? Are we going to see a lot of dramatic reefer falling rates once produce season and once harvest season's kind of done? Or are they gonna, is reefer gonna, stay on top and have higher rates than pretty much everything else?
Well, very similar to what we've seen on the van side of things, refrigerated equipment market has really seen an easing here into the start of the fourth quarter as well. So I think we're seeing that slowdown come into play. But one thing we know is people like to ease, especially around the holidays. And we don't expect to see unseasonal demand around the holidays, right? And so one of the trends we really saw through summer peak season with refrigerated freight and through the harvest seasons were these pockets where you saw demand surges, you saw increased routing guide disruptions to levels that we're not seeing on the van side. And so our take on that and our read on that is you see tender rejections pop up above 10, 12%. That's a sign that the recovery might be a little bit further ahead on the refrigerated side of things. And so with that, we also think vulnerability to seasonal rate volatility, and then even vulnerability to disruption as we get into next year.
I want to say that one time I actually looked up how many reefer trucks it takes to get all of the Thanksgiving goods where they need to go, and it's something like 15,000 for just turkeys, like not including all the sides. And that to me is absolutely insane. I know it's like the weirdest fun fact that I have in my head, but it is absolutely insane that it's that many trucks to get all of the turkeys where they need to be for Thanksgiving.
People might buy less gifts this year, but they're probably not going to eat less turkey. So
that is true.
From a demand perspective, we have some concerns around retail demand, but we also think that it could be a bright spot as we get into next year. A lot of upside on the consumer spending, trends as of late. Consumer spending, seasonally adjusted, inflation adjusted, continues to grow. The consumer is relatively strong as a whole. That's helped run down inventories. That's created a situation for retailers to revert back to more normal ordering patterns and potentially more normal import levels as we get into retail import levels as we get into next year, and resetting this inventory cycle. So we think retail demand, assuming the consumer remains strong, should potentially be a bright spot as we get into next year.
I'm kind of hopeful for that as well. I mean, there's a lot of doom and gloom out there, but I have faith in the everyday consumer getting back on the horse and getting back on spending, myself included. But one of the things you kind of brought up a little bit was the volatility in routing guides. What do you think that's only going to happen on reefer, or do you think that dry van is subject to that volatility as well, and kind of what some of those external factors that could disrupt those routing guides that maybe shippers need to be aware of?
I think it comes down to the shipper and their carrier strategy and how they've leveraged spot versus contract through this cycle, and how they've leveraged brokers and assets. And, if you've really looked to brokers and push down on rates, your contract rate might be a little bit closer to the current spot rate, right? And if that's the case and we see spot rates pick up a bit, you're more prone to seeing routing guide disruption, just from having a larger degree of risk with lower contract rates, right? Those that have rates in place with larger asset carriers that are at a sustainable level, or even with larger brokerages at a sustainable level, they're going to see less risk of disruption, right? And so I think it comes back down to just, where we're at in the cycle, the supply and demand balance, and the ability of the carrier that you're choosing to contract rate to, broker or asset, their ability to continue to provide that level of service that meets your expectation.
I kind of like that because the whole last year has been such a emphasis on relationship building and, cut carrier service and, not really letting carriers who lack good service kind of get away with it, if that makes sense. So I like that potentially that could continue to be a trend. I think really, like you said, it just truly does come down to, building those relationships, making sure that you have great carriers, and that, you know who you're partnering with and they live up to your expectations. And I know every shipper has different expectations and different things that they value. So it truly is, there's someone out there for everyone. You just got to find the right carrier for you.
I mean, shippers are pretty smart, right? They know if you can't provide good service in a market like we're in today, you're probably not going to be a good partner when the market flips, right? And we've seen that on the shipper side. We've seen a lot of shippers cutting down on their carrier networks, right? Big reductions. Pandemic era using 50 plus carriers, now using 10 or less. A lot of cleanup on the shipper side. That's created a lot of disruption for brokers, right? Their ability to continue to compete. And you hear a lot of narrative on the side of freight demand fall off. A lot of that is just what type of demand you have access to, right? Are you still getting in with the shippers who are moving freight? It's our opinion that the freight market in general remains really well supplied with freight, and there is still a lot of freight moving, and so we don't really buy into as much that, hey, demand has significantly fell off a cliff. More so, we think access to that demand has fallen off a cliff, and a lot of that's come from different trends we've seen. Shippers have invested in private fleets, assets continue to add capacity. You've seen that in new truck orders most recent month, spiking as build slots opened up for next year. Not every carrier is experiencing the same downturn.
I like that because it's truly everyone has their own different business, and what works for a small carrier that might have 2 or 3 trucks is obviously completely different than a mega carrier that has, an enterprise carrier that has maybe like 1,000 trucks or something like that. It's truly different for everybody. And I mean, that just goes to show that, again, for every shipper, there's a carrier that matches it. I'm a big proponent historically and, still to this day, of shippers kind of bringing their network in closer. Obviously you're going to have stuff that needs to go out to the spot market and use those carriers from time to time. That's inevitable. But personally, I am a really big fan of having a pretty tight closed network, or at least a pretty strict routing guide, because like you said, I feel like you get stronger quality, you get a better relationship, and you get those things that you want out of your partners a lot easier. But that's just my 2 cents from back in the day.
No, I think that it's important too to know who you're working with right now. One of the biggest topics in our industry right now is fraud and theft, right? And so when you know who you're working with, you cut your carrier base down. You have good relationships with those you work with. You really reduce your risk in those areas.
And it really is. I mean, I know that, your standard carriers aren't going to be a great fit for anything and every load that comes your way. But for a majority of it, I think is one of the easiest ways to keep yourself from being susceptible to fraud and theft and double brokering and all of that, which is not something that anyone ever wants to deal with. I don't know anyone that's woke up today and say, let's go find a double brokering case to get involved in. So what do you kind of think is going to happen with fuel over the next 6 months? What does that forecast have for arguably the one thing that is the hardest to forecast?
Yeah, and it's getting even harder. I mean, you see what's happening in the Middle East, and first and foremost, I mean, it's just heartbreaking to see the loss and what's going on there, and then obviously what that means for potential, um, let's say regional war, regional conflict. Who knows what could end up happening in the Middle East, right? And we all know that impact that has on fuel supply or oil supply, and what that could mean for fuel prices domestically. So, very little understanding of exactly what the risks are there, but I would say probably really high to the upside in terms of what we could see from an oil price, impact should there be a growing conflict or growing war in the Middle East. Something to be mindful of there, right? But what we know is when fuel prices go up, that can be disruptive. That can create additional financial stress for carriers, especially smaller carriers, a lot of spot freight access. Maybe they don't have the contract freight that has that variable fuel component, right? And so as fuel prices go up, we tend to see lagging revocations of authority from that, as we see carriers that didn't really necessarily understand their cost structure suddenly find their margins pinched a bit more. And so at a time where rates are already unsustainably low on the spot side, you add additional financial stress from increased fuel expense, and that certainly could accelerate carrier exits, especially smaller carrier exits, as we get into next year. And hopefully we don't see growing unrest in the Middle East, and we see things calm down, and fuel prices can come down. I think that's what everyone would want to see.
Is there anything that a shipper can do or even a broker can do to kind of mitigate some of those high fuel charges, or kind of any strategy that they can implement to maybe, help their carriers out, help themselves out for potential big swings in fuel?
I mean, first and foremost, you need to know your cost structure, especially as a carrier, right? Know your operating expenses to the itemized detail. And as your fuel expense goes up, you should factor that into how you're quoting your rate per mile to whomever you're quoting your services for, right? And know what you're paying for fuel, and know how that impacts your profitability. It's just good business sense to do that, right? And I think across the board, and then ultimately, don't be afraid to set up your services with a fuel schedule, right? If you are doing things contractually or consistently, negotiating a fuel surcharge that is indexed to a national average. That's something we see very commonly in our industry, and I think that's something that provides reassurance and support, and helps keep pay very fair as fuel goes up and down. And that's something that we recommend, and we do ourselves, right? We work with a lot of carriers, and we're not just buying exclusively in the spot market. We're packing together contracts to give to carriers to run, and we're doing so on fuel schedules. So don't be afraid to ask and set those up if that's something that you do.
I like it. It's it's kind of we're in this together. We're not just going to kind of try and screw you over. We're really going to work with you. But we are running out of time. And David, that means that I have another hot take question for you. So if you had to choose between a pet dinosaur or a pet dragon, which would you choose?
I mean, these questions, they keep getting better and better. I think like right now it comes down to one key difference, right? Like in my mind, dragons are kind of like dinosaurs and vice versa, but there are dinosaurs that fly, right? That I presume if you could train a dragon to fly on a dragon, you could probably do that with a dinosaur. But dragons can also breathe fire, so like that's one thing. I haven't really seen any dinosaurs, breathing fire. So I guess that's the way I would lean.
You're team dragon for the fire breathing aspect.
I guess, right? Because there's what else? What's the other difference?
I mean, if you rolled up into a meeting, or if you brought your pet T-Rex to work, like I don't feel like anyone would ask you to do something that you don't want to do that day.
Well, they certainly wouldn't ask you to reach something on a high shelf.
That's a good one. So if anyone wants to, question your dragon versus dinosaur choice or, reach out to you about anything we talked about today, where can they find you outside the show?
Yeah, I always direct everyone to arrivelogistics.com. All of the content that we're putting out there, you can find there navigating to our insights page. Additionally on LinkedIn, we're very active, both the Arrive Logistics page as well as myself. They're sharing our content and sharing our thoughts on what's going on in the freight market. And happy to talk about what we're seeing and what we're forecasting, as well as, we didn't really get to it today, but how has our forecast performed over the past year? And really what qualifies us to even put a forecast out there. Happy to talk through all that. And but thanks again for the time, Mary. I really, really appreciate it.
Hey, anytime. There's no other market expert I'd talk to.
Thank you very much.
Find Check Call the Podcast anywhere you get your podcasts, like Apple Podcasts and Spotify. Don't forget to check out all the other incredible FreightWaves podcasts, such as Rethinking Reshoring and Great Quarter Gals. Don't forget to subscribe to the newsletter on freightwaves.com/checkcall. See you on the internet.